Good afternoon, everyone. Welcome to the second of the FinGeo online seminars of this semester. We've had a little bit of a hiatus because we had to postpone one lecture due to the illness of one of the speakers. But as you may have seen online in the meantime, I'll post the links in the chat later, or someone else can post them if they like. We have now a full program for this semester's FinGeo lectures. So we have another one next week. That's the original one by Manuel that was supposed to be a few weeks ago. And then after next week, there will be one every 2 weeks till about mid-May. So we'll say more about the program in a bit. But of course, the main thing today is that Rachel Weber will be speaking. I won't be reading out her biography as people often do. I'll give a little bit of a personal twist to it. As you've probably already seen, she's a professor of urban planning and policy at the University of Illinois. I'm a great fan of her work. I've been following it for a long time. For me, Rachel is one of the important people that works on the intersection of urban geography and more financial geography and urban planning, one could add as well. You may know her from her book, From Boom to Bubble, How Finance Built a New Chicago, or from very well-cited papers in Antipode in 2002 and Economic Geography in 2010. But there's also a lesser known work by Rachel that I like a lot and that I could recommend to people. It's a book from, I think, 2001, Swords into Dow Shares. And it was very hard to get it at the time. I got a secondhand copy. But looking up now, again, the exact title, I noticed that there's an e-copy now of the book available. So it should be much easier to read it now. And I know it hasn't received a lot of attention, that book, but I think it's the book was a bit ahead of its time. So maybe now is the right time, 20 years later, to read it. Okay, without further ado, I'm going to give the floor to Rachel, who's going to take about half an hour to speak. And then after that, we'll have time for Q&A. And if anyone has their microphone on for whatever reason, please turn it off. And then at the end, I'll give people an opportunity to turn the mic on if they want to ask a question rather than just putting it in the chat. Okay, Rachel, I'm looking forward to your talk.
Thank you, Manuel. It was thank you for that very kind introduction. And I'll say that it's just been such a thrill watching you all come on to the Zoom. That I almost forgot I have to give a talk. I thought we could just, have a conversation. I hope, are my slides showing now?
Perfect.
Okay, good. Thank you so much. And let me just set my timer here so I don't go off too much. So yeah, thank you, Manuel and Fabio, for inviting me to present this work, which is very much a work in progress. So I'll look forward to your comments and suggestions after my talk. So, if you can think back or remember 2 years ago, back to March 2020, you may recall that generalized sense of panic that we felt at the onset of the COVID-19 pandemic. The public health emergency quickly spiraled into an economic one, and the sector that I study, real estate, also started lurching into crisis mode. For 6 months, from about March 2020 through September of 2020, there were almost no sales of commercial real estate in the United States. And by commercial real estate, I mean income generating office buildings, malls, multifamily apartment buildings, industrial properties. Excuse me. And because there were no transactions, investors did not know the true value of their portfolios. Euphemisms that were used at the time were quite revealing. Capital was in a phase of quote unquote price discovery, and public markets like publicly traded real estate investment trusts were supposedly trading on sentiment amidst the dearth of transactions. With the future unsettled, suddenly everyone was a forecaster, an amateur epidemiologist. So you saw talking heads on TV and on the web, interjecting future-oriented propositions into the slow flow of the present. Global real estate firms, trade publications, and membership organizations shared their own opinions about how long they thought the recession would last and their visions of when and why a rebound would occur. But throughout 2020, their forecasts were not converging. there's an organization called Consensus Economics. It's a private firm that surveys experts and publishes their sort of expert forecasts and their advice. And they said that the April 2020 forecasts for US GDP growth in 2020 had the largest standard deviations and range since they had started collecting them. They varied from anywhere from like minus 1.3% to minus 8.5%. Many of the reports published by global real estate firms like CBRE and JLL at the time were surprisingly humble, excuse me, and candid about the limits of human knowledge. Like this quote from a pension, someone who's an analyst at a pension fund, they sort of revealed the fact that they were just as confused as we are. They were treating the pandemic like a black swan, a high impact, low predictability event that was making the industry's forecasting models, as this interview subject said, useless, right? That they were not, this is a guy who was talking about, you know, the data that they were trying to get in real time and saying that basically everybody in the firm had serious doubts about this data, and that they knew they had to write down the valuations of their portfolios, but everyone was kind of, you know, too scared to be the sort of first person on the dance floor. They didn't know by how much they should be devaluing those portfolios. And then almost as quickly as the mood came down, it lifted back up again. Real estate investors like private equity firm Blackstone started reporting record-breaking performance starting in around the second quarter of 2021. Last year, the issuance of commercial mortgage-backed securities, which are the financial instruments that I tracked in my last book, rose to their highest volume since 2007. An analyst from TREP, which follows these commercial mortgage-backed securities, summed up his state of mind and the state of mind of the whole industry, quoting the Lego movie, "Everything is awesome." Of course, the awesomeness was mainly reserved for owners of income-generating property. Tenants, like those in New York City, as you can see from this image, sorry, Manuel, were paying record-breaking rents, right? Median rent jumped 23% to $3,467 in New York City. So in my talk, I'm going to offer one explanation for this rapid turnaround. As in my earlier work, I assume that capital's movement through the built environment must be facilitated and arguments for its free passage articulated by actors. So my work has always been very sort of actor focused. These actors possess expert knowledge and stature in the field, the legitimacy to sort of convince capital to sort of part with its money. My new book project is looking at the relationship between speculation and prediction in real estate. And in it, I also highlight the role of actors, mainly the actors who are forecasting future real estate trends, these sort of half rational, half magical outlooks, market outlooks and forecasts and projections that shepherd their own firms and their other clients in the industry toward and away from particular assets at roughly the same time. Thanks to Manuel and others here on the call, on the Zoom call, I see that, you know, I think we're all familiar with the fact that since the 1990s, there has been a significant and substantial uptick in capital flows to commercial real estate. But less examined is the fact that during the same time frame, there's been a proliferation of predictive data and knowledge practices that guide those flows. So in addition to new technologies and new platforms like Zillow and Redfin, there have been subscriptions. There are subscriptions to sales data and monthly outlooks, statistical indices, and build your own modeling templates, as well as bespoke forecasting services are now widely available and a lucrative sort of segment of the real estate industry in its own right. So my project is an ethnography of this segment, of the analysts who build these databases and develop these models. Sometimes they're called quants. That capital depends on to lead them into the future. The future imaginaries that these folks produce are performative in that they conjure up the possibility of short-term price differentials in the face of the uncertain. I'll argue that their performity, or the performity of forecasts, is due less to their accuracy. In fact, they're often horribly wrong, and more to their role as expectant and effective with an A, communication that shapes opinions. In the self-referential world of real estate speculation, where value is based more on the anticipation of appreciation than on current cash flows, altering expectations can have very material effects on behavior and pricing. It's not that professionals in this industry were able to narrate their way out of a crisis, but by adopting certain futuring strategies, they were able to control the means of prediction and profit from what looks to be on the surface a surefire calamity for this asset class. So a little background about real estate speculation. Right? We know that global real estate firms, asset and investment managers control this market, the commercial real estate market. It's valued at approximately $16 trillion in the United States. And this amount, the 16 trillion, represents not only their own capital, the capital of these firms, but those of others, pension funds, sovereign wealth funds that invest their money with these firms and through them invest in commercial real estate, but also in the assets that are secured by real property, like derivatives. Ownership of property entitles these folks to monopoly control over location, as well as the legal right to capture rents and any increases in value. For speculators, it's really this expectation of short-term value change, capital gains or tax losses, that matters, as opposed to the rents from leasing property. Although in the literature, there's some kind of confused distinctions between landlordism, rentiership, and being a speculator. Oftentimes, for example, the goal of landlordism is to convert or transform the surplus value derived from rents into an asset that can preserve and accumulate surplus value. So there's not as much of a sort of distinction as I think there can be. Because of property speculation's association with gentrification, we often assume that speculators want values to go up and that they want to avoid crises. But as we know from work on climate finance, I see Zach in the audience and Sarah Newth's work, whether values experience positive or negative change is less important than the magnitude of future price differentials. For every party that wants property values to go up, there's one or more counterparty who has taken a short position and is betting that values are going to fall. So for example, in the last few months, there have been several owners of office towers in Chicago's Loop and in Midtown Manhattan that have announced that they're delinquent on their mortgages. And this is obviously bad for those owners, but it's good news for those who buy distressed debt or who provide insurance for these or against these kinds of adverse effects. Another, I think, sort of misconception about speculation is that speculators are kind of lone wolves. But betting on an asset's future value is less of a calculated move by a solo firm or individual scanning the environment for a perfect opportunity, and more of a process of observing one's peers and operating within a series of linked and leveraged bets that comprise property markets. Speculators are connected and linked to each other through chains of valuation. So every time one of your peers purchases a property near one that you might own, or they purchase a similar kind of property that may even be far away from one that you own, it becomes a comparable, and affects your property's future value, no matter how unrealistic the sales price might be. This is a quote from someone I interviewed who works at a real estate investment fund. And the first paragraph does kind of give you that kind of lone wolf, like speculators as visionaries trying to find that kind of perfect opportunity that no one else sees. But then the second paragraph, if you read it, sort of shows just how sort of social and collective an act speculation actually is. You need other members of your industry imitating you and imitating each other at roughly the same time to create a kind of speculative dynamic. If you make an investment, but then no one else follows you, as this interview subject says, your property is not going to increase in value. And I think it's this kind of sociality that, neoclassical economics has always kind of ignored. And in fact, there's not a whole lot of great writing within kind of mainstream or, sort of orthodox economics about speculation. Many folks deny that it even exists. I think if you're an adherent of the efficient market hypothesis or theory, you believe that markets are informationally efficient. And so that leaves no room for abnormal or speculative returns. Like they'll only admit that speculation exists when there's something called mispricing. And there are a lot of different sort of aspects to speculation that mainstream economics sort of doesn't understand. For example, instead of competition reducing opportunities for profit, we see speculators benefiting from others entering markets where they're active. Instead of rising asset prices dampening demand, we see higher prices often inflating demand in a kind of self-reinforcing or positive feedback loop. So I think, taking a more sort of socioeconomic or institutional perspective on property speculation, makes more sense. I've always argued that. And when you're looking, kind of dissecting actual sort of instances or sort of speculation or speculative markets, you see, how important it is for speculators to try to kind of overcome the problem, kind of collective action problems and timing problems. When you're an individual real estate investor, you depend on the imminent behavior of your peers, but you can't necessarily control or coordinate this sort of vast network of dispersed actors, operating in diversified and global markets. Speculators even have a hard time just sort of seeing the markets where they're active, and that's important. There's another definition of speculation that derives from Latin, which means observation or the act of looking. And property speculators have a hard time just seeing and identifying sort of what's going on, sort of who's buying what. The identities of buildings as financial assets are often hard to see. And certainly more so than the stock market, where the communication of prices is temporally and spatially condensed. Financial transactions are not necessarily imprinted on the built environment, apart from the spectacle, the spec of new construction. But even before you see cranes breaking ground and new buildings kind of arising from the ashes, for speculators, it's already too late to get in on the action. This is a picture I took on the north side of Chicago. I thought it was interesting. It's for one of the gazillion of new multifamily apartments sprouting up across the city. I thought that this image, the poster for the upcoming building was interesting because one of the partners, the financial partner, was called Free Market Ventures, right? And I had to do a little research to find out who is this Free Market Ventures. I hadn't heard of them. They're an offshoot of a developer, the John Buck Company. But I thought that this idea again of this sort of speculator being the lone wolf, that's kind of what this kind of quote that I took from their website says, that they're trying to sort of uncover these kinds of opportunities and to sort of see into the future. So speculators are seeking subjects. They want to be able to see these yet to be realized possibilities for extracting value from urban space, which means anticipating not yet occurring behavior of their peers. Specifically, property speculators want answers to such questions as, when will returns from investment in real estate rise or fall? And how will real estate perform relative to other asset classes? Which regions, submarkets, building types will be popular in the short and long term? How will a particular asset, like this shopping mall that I own or that apartment tower that I'm considering buying, perform over the next 3 to 5 years? But opportunities, unlike, no matter what this sort of free market venture says, opportunities don't necessarily just exist sort of pre-exist, to be found by speculators. Speculators are also shaping subjects. It's not possible to differentiate between their expectations of property values and what those values in fact are. Anticipation is constitutive of value and of value differentials. Speculators try to shape those expectations through the production and circulation of different kinds of future imaginaries that alter the now, the future working backwards on the present. And this is where this world of forecasting comes in. It's the job of the forecaster to try to speculate and see and reveal the sort of underlying socioeconomic, financial dynamics of markets to fulfill the prediction imperatives of their employers and clients. Forecasts are real-time representations of future situations, which are related not just to what they know as sort of formal knowledges and assumptions about how economic time operates, but to what they can expect. They are future abstractions and expectant projections that arrange action in time and link its flow to capital accumulation. Forecasters can be found in different parts of the real estate industry. Just sort of moving counterclockwise in this slide, you see that, actually you'd find the largest number of forecasters at home and sort of embedded within full service global real estate companies, like JLL, as well as embedded in financial firms that over the last 20 years have more fully developed their own sort of real estate divisions. So asset managers, the property service divisions of banks. So you'll find research departments within these large firms, research departments that hire economists, but also computer scientists and mathematicians to try to help their firms decide whether they should, say, invest in either San Francisco or Seattle. And if the answer is Seattle, then whether they'd be better off investing in apartments or in suburban office campuses there. You also see sort of working around on the slide, private data companies that cater to these large firms with data sets and also do their own analytics. So they hire sort of chief economists and they have research departments as well. These are companies that commodify future knowledge, mainly by selling data about the past. They license their subscriptions, different kinds of property data. They offer reports covering different geographies and different sectors of the real estate market. They sell products like climate risk scores and COVID-19 economic forecast scenario software. This segment of the industry has become much more consolidated since the global financial crisis. And CoStar has mainly been sort of gobbling up a lot of the sort of smaller data companies. And then you have specialized economic consultants that are, with kind of future-oriented names, as you can see, that work on special projects and help smaller companies, smaller real estate companies that don't have their own in-house research departments. And there's a new breed of consulting firm and data firm, and that's why these sort of prop tech companies are kind of in the middle, because they're similar to the data companies in that they, are sort of selling data, often data that they've sourced from some novel, through some sort of novel computer interface or through AI or machine learning. They're tracking tweets and mobile phone signals or collecting data through sensors. But then they also do their own analytics. Again, they hire economists and computer scientists, particularly those of kind of, who are sort of proficient at, manipulating big data. So this is sort of the world that I've been interviewing for the last couple of years. These are folks who their day-to-day work involves moving, arranging, ordering retrospective data in the calculative spaces prefigured by software and analytical models. Most of that software is, or often that software is, something simple like Excel. Their spreadsheets create outputs, enumerate traits, and attribute propensities. Their models include generators of simple descriptive statistics, like average changes in rents, or regressions to let their superiors know that they can expect a 4% increase in rents per year over the next 5 years. Some rely on more probabilistic and complex techniques like Monte Carlo simulations, but honestly, I was quite surprised by the simplicity of the methods that were used in this industry. They seem to invest more faith or credibility in the data itself, which they want to be big, of course, granular and high frequency. Aside from the model developers themselves, most of the others in the firms treat the technologies as a kind of black box, the models as a kind of black box, imbuing them with oracular powers that sort of spit out the answers to their questions. These models generate different kinds of output. Here's some examples of different kinds: point forecasts, turning points, confidence intervals, scenarios. And this information is conveyed mostly internally to investment committees and to portfolio managers who are responsible for investing their firm's capital in different kinds of real estate assets. However, forecasters operate on an external front simultaneously. They have to kind of advertise and promote the smartness of their firms and position themselves as knowledgeable and authoritative, both to attract more business, but also to shape the expectations of others in the field to increase their firms, their firm's profits. So you'll find a glut of their forecasts in trade publications, press releases, podcasts, demand estimates, even municipal bond prospectuses. Some firms like CBRE publish reports quarterly, others annually. And now, given their sort of multimedia availability, you'll find sort of podcasts that sometimes are uploaded as frequently as every week. These are also firms that both sponsor and attend Outlook events, such as those that are offered by the Urban Land Institute, at least in the United States. Often in conjunction with accounting giants like PricewaterhouseCoopers or with universities as well. So you'll find these forecasts in all different kinds of fora. The report's US securities regulation, I found this interesting, has even created a special class of speech for forecasts. It calls them forward-looking information, or FLI. So the reports and the podcasts all come with warnings like those on a packet of cigarettes. So classifying predictions as this FLI, forward-looking information, exempts the issuer from liability in the event that those predictions don't pan out. So what should we make of these forecasts? There's a school of thought, the kind of rationalist or realist school, mostly orthodox economists, that assumes that forecasts can be accurate representations of the future, and that they are valuable in helping capital to sort of capitalize into present day prices, sort of future events, so that they can avoid sort of shocks to the system. There's another school, I'd call it more sort of constructivist, mainly cultural geographers, science and technology studies folks, that views forecasts as stories about the future whose accuracy is kind of sort of beside the point. They are masked illusio, shrouds that provide flimsy cover to capital as it goes about its business appropriating surplus value. So that the forecasts provide a kind of veneer of smartness and quantification that allows firms to extract additional sort of knowledge rents. I'm finding myself in this research charting a third path. I don't believe forecasts can necessarily be prescient given the unknowability of the future. And I do agree with the kind of critical constructivist scholars that these market outlooks and forecasts are imaginaries, but I don't believe they're just for show, smoke screens that obscure the real work of capital accumulation. Even if future markets are not predictable, property forecasting can still be a generative, productive force in the material world. So I'm coming to the conclusion that forecasts are a kind of effective communication. They offer a vernacular that removes the pressure of rational understanding and allows speculators to feel an intuitive, visceral connection both to each other, to the crowd, and to the uncertainty surrounding them, kind of like a horoscope, hence the title of my talk. So even if, when you don't believe them, you still kind of believe them. Like this morning when I was preparing for this talk, and I kind of chided myself because I saw my little, schedule, and I said, wow, Rachel, you're being such a Virgo. And I think these forecasts are important. They're not just something we can ignore, not just, again, sort of just for show, that they, that they can affect the geography and timing of capital flows, that a mutuality of expectations will affect the price assigned to the future, and so enable these kinds of promissory abstractions to produce their own realities. And I'll talk a little bit about this just in my remaining, looks like I have about 5 minutes, about the pandemic. So speculators were not necessarily, or speculators in general don't necessarily dread uncertainty or seek to tame it. They just want kind of uncertainty and turbulence that they understand, that can create opportunities for them that they can profitably exploit. They're looking for a consistent narrative of the unfolding and emerging events that can be incorporated into their own calculations. And that was kind of the problem at the beginning of the pandemic. There was no consistent narrative. No proposition seemed to dominate over any others. And there were kind of dueling expectations that were sort of thrown out into the void because industry had stopped meeting in person. Forecasters described, at this time, a feeling of kind of swimming upstream in a barrage of information, conflicting information that was available online and on social media. And then JLL, one of the big global real estate firms, tried to step up. They kind of threw out the first ball. They said in April of 2020 that the consensus, so they said there was consensus, the consensus forecast is for a sharp shock to the global economy, followed by a bounce back, reminiscent of the recovery after the SARS outbreak in 2003. A few days after the report was released, Goldman Sachs, JP Morgan, and Moody's were all kind of mimicking this information, predicting a short and sharp drop with a quick and resilient rebound to economic growth. And this was great news for the industry, this V-shaped recovery. And especially because 2003 was the beginning of the best sort of 4-year run that the industry had had to date. Naming the pandemic as an interruption meant that it was time limited and could be brought to an end quickly. A sharp spike would maximize the differential in the shortest turnaround for those who had the capital to buy low and sell high during the short window. But then no one moved. It was kind of like the industry was frozen. Expectations are often most intense during the early stage of a crisis. But early imaginaries are also likely to differ from reality as it develops. And indeed, market actors could not hold on to this V-shaped recovery. They could not hold this narrative in place. The virus was moving across the globe in fits and starts, blurring the boundary between normalcy and emergency. The optimism of futurists was being drowned out by the bad news undermining capital's modal orientation to the future, which was optimism. Direct investment in global commercial real estate decreased by 5% year on year in the first quarter, and then the news only became worse. Requests for loan forbearance, the forecasts for 2021 were still quite negative, even up through the third quarter of 2020. I was interviewing folks at this time, and if they weren't losing their jobs, they were talking about having to change the story and reestablish the context for an industry whose lifeblood is growth. They used a couple of different strategies that I'll mention very quickly. I see I'm kind of running out of time. First of all, the big firms really stepped up. They became more active and vocal as they kind of controlled the sort of means of prediction, particularly after a couple of years of consolidation in this sort of real estate forecasting world. So you had a small number of actors who had a sizable amount of influence over the sort of means of predictions. You know, obviously having a vaccine, the COVID-19 vaccine, was a key turning point in the beginning of 2021, but I think it was more than this. Even though the vaccine was referenced heavily in a lot of the publications that real estate firms were putting out, you know, there were other factors that were sort of increasing the sort of confidence for the future. There began to be some sort of green shoots of good news as certain industry segments started to perform very well. And this was kind of the messaging then that changed at the end of 2020, was that there wasn't necessarily going to be a V-shaped recovery, possibly more K-shaped, which is what you see on the right, with certain segments doing incredibly well and others that basically needed to be sort of sacrificed to the volcano gods. And you needed real estate forecasting to tell you which ones they were going to be. And so sort of making an argument for even sort of more importance for forecasting. And so you see also sort of the real estate firms like CoStar were sort of really sort of stepping up with this idea about the importance of knowledge in order to navigate through this sort of future uncertainty. And I show this slide here just because I think it's interesting that CoStar is also the name of an online astrology platform. So it shares the same name as CoStar, the kind of main source of real estate data. So there was this real emphasis on disaggregation, triaging assets to raise up the strong and quarantine the weaker and riskier ones. So the winners, it was argued, would be in industrial properties, so e-fulfillment centers and warehouses, suburban apartments, specialty property types like medical office, life sciences, and self-storage. But the losers were going to be hotels, restaurants, followed closely by retail and downtown office. So this attitude that you have sort of some market segments that are going to do very well and others that will not, and that you needed forecasting to sort of tell you which ones those were going to be. Similarly, certain locations were going to do really well. Particularly, the predictions were that mid-sized second-tiered cities in the South and West, like Nashville, Phoenix, Salt Lake City, Austin, Tampa, would be characterized by high demand and rapid price appreciation. But then others, particularly coastal markets, would be feeling the most pain. And then they also emphasized the importance of choosing the right assets during this period of intense uncertainty. In contrast to the previous boom, there were more single asset deals as opposed to big portfolio buys. And looking at the sort of financial markets, we see that more market-backed securities were secured less by kind of bundled mortgages and more by single trophy buildings. And they argued that this was a way of isolating risks so that it wouldn't spread throughout the system like it did during the global financial crisis. And that was also another sort of forecasting strategy, which was to distinguish the global financial crisis of 2007-8 from what was happening with the pandemics, sort of boasting about the experience that these firms had, again, sort of navigating through previous crises, and the importance of the kind of intuition that they developed through that experience, that they knew when to manually override certain embedded assumptions in their models based on that kind of experience. So reading through these documents as I have, these sort of forecasting documents over the last couple of years, you see an almost sort of blasé affect, sort of nothing to see here folks kind of calm. Ever aware of the performativity of forecasts, they know to adopt a kind of unflappable and dispassionate approach to crisis management to prevent panic in the echo chamber of real estate speculation. And I'm sorry, I'm rushing just because I realize I have just a few more minutes, but I just wanted to conclude by saying, while the cacophony of disjointed and contradictory forecasts added to the confusion and crisis of 2020, the consistent narratives of recovery for particular building types and locations assisted real estate markets in bouncing back. In 2021, it was like we were back to 2006, right before the global financial crisis, in terms of the velocity and size of transactions, year-over-year returns, increases in asking rents and values, new construction, absorption, and vacancies, very low vacancies. So, we see that the future is so important to real estate and to these expectations. This is one of my favorite quotes from Jim Graskamp, who's kind of the father of real estate forecasting, who died unfortunately very young. This is from his textbook. But crises like the pandemic reconfigure present-future relations. And after a brief pause, we saw that real estate forecasters had successfully summoned an imminently positive future, drawing the interface between the present and future ever closer. On their own, forecasts can't build buildings or develop submarkets or help an entire industry recover from a pandemic. They're not the main form of labor from which the surplus value in property is extracted, but they are an underappreciated part of the sort of soft assumptions, as Graskamp says, or the expectancy systems that I talk about that anchor speculative financialized cities. The predictions that these modern day prophets make are important instruments of real estate finance, not because they accurately represent the future, but because they create and fortify the collective subjectivities and shared imaginaries necessary for actors in this industry to relate to each other through uncertainty and through the simultaneity of time and place. And I will end here. Thank you.
Many thanks, Rachel. And now it's time for some questions. I already see some questions by Andy and Derek in the chat. If there's anyone else, you can put a question mark or a Q in the chat. You don't have to follow the chat, Rachel. I will just give the floor to people and they can turn their mic on and ask the question. So no need to focus on that. I'll keep an eye on that. And I'll take the liberty to ask the first question myself.
And Manuel, sorry, should I stop sharing too?
Yeah, you can stop sharing. That might be better. Okay. Then we can see each other a little better. Yeah, great. Okay. I forgot to say that, but good to see you thought of it. So I'm trying to ask my question at two different levels of abstraction. And the first way to phrase my question is your relationship about forecasting and speculation. You talked about both, but I'm still trying to see if you can be a little bit more precise about what the relationship is between the two. Would you say forecasting enables speculation? Forecasting facilitates speculation? Forecasting makes speculation more likely, less likely, more widespread, less widespread? What will be the effect of prices? And then we get a little bit to the way you discussed it before about mainstream economists saying like, well, there is no speculation. And they also say like, well, all the information of forecasting would be great because more information means a stabilizing factor in the market. Whereas a lot of critical geographers, critical planners, etc., would say like, wow, actually a lot of those things might be actually destabilizing. They might lead to more fluctuating prices. So then we get to a question where like, well, we know that the mainstream economists are mostly wrong. And you said like, oh, you're inspired by STS, but they say there's no effect. So we don't really agree with that either. I mean, you and me, maybe other people in the room as well. So what can we take then about what the effect is? If there is an effect, what is this effect that we can see of the forecasting on the speculation?
Yeah, no, I mean, I'm trying to better define and kind of discuss the sort of nuances and also talk about the kind of practices on the ground that help to guide capital and inform capital's decisions. And I am making an argument for the significance of forecasting. So that's, and so what is the significance? I would argue that the forecasts help to kind of corral the crowd, and sort of shepherd, I use the word shepherd and corral, these kinds of, these sort of farming kind of, or livestock raising kinds of metaphors toward particular assets toward particular regions at the same time. So they, I think, play an important role in this kind of hyper mimetic, often sort of copying each other type of an industry. And I'm sure, there are other industries that behave in this way. I look at the real estate industry, and sort of people have written about hype and how important this kind of, information intermediaries are to, to again, sort of affecting investment behavior. And I think I'm sort of adding to that by showing again in real estate, just, how important this is, particularly because there is this kind of seeking and grasping for information to define this kind of, this multi-headed hydra, this difficult to kind of to follow type of a market. And so it's created this sort of need for information, but I don't necessarily take the information at face value in the forecast. And again, I'm sort of, unlike more orthodox economists, the accuracy of the forecasts and their believability, their credibility is sort of less important to me and then in sort of the kind of work that they do. So yeah, I would say that forecasts enable and facilitate speculation. I'm not to the point where I can say sort of more forecasting equals more speculation. I think it's sort of the power of particular ones and how those get sort of absorbed into the kind of calculative, both the calculative practices, but also the kind of investment practices of these real estate actors and speculators.
Okay, thanks, Rachel. We'll now go to questions from the audience, and it's Andy Pike first. Andy, if you're able to turn on your mic, that would be great.
Yeah, thanks, Manuel. Nice, lovely to see people, albeit virtually for now. But yeah, thanks, Rachel. That was, as ever, a really interesting, thoughtful presentation. I suppose a couple of things I raised there. I mean, one, I suppose the nature of the pandemic was unlike other shocks in many ways. Stop start, it ebbed and flowed. It wasn't like the financial crash back in 2008 in a way. Had different sort of rhythm and scales to it, I suppose, in terms of its timing. And certainly a lot of uncertainty was created. But then I suppose as you had these sort of embers of recovery starting to emerge in certain places, then did that mean that you had investors following the forecasts, as you say, copying each other, sort of crowding in, fueling competition then for what might be the most prized urban assets within particular cities? So that was one question. Mm-hmm. Almost like herd behavior. The forecasts were helping. And the second one, you said a little bit, of course, about language and narrative in communicating meaning, and I wonder, how that relates then to about issues of confidence. Because you're kind of sort of trying in the midst of recovery to build confidence that real estate or certain categories and locations are still worth investing in, because you're going to be able to appreciate the values of your investments. And it switched the light bulb on in my head about Julie Froud et al.'s their work on financialization, this idea of narrative and numbers. They're both equally important. You need the poets and the quants to create this meaning and confidence. So I wondered how that sort of played into the work that you've been doing, but very enjoyable stuff. I look forward to the book. Yeah.
Thank you. Yeah, no, I mean, that's kind of, if I had to sort of say what my sort of underlying theoretical motivation for this project is, it's been a desire for many, many years to kind of reconcile this sort of constructivist approach to, kind of S&TS informed, kind of cultural geography informed understanding of finance and real estate, with a more, sort of Marxist, materialist, quantitative understanding of what's going on. And I do see the so rather than sort of see them as sort of separate tracks or separate frameworks or lenses through which we should be viewing phenomenon in this sector and others, I'm trying to find a way to kind of to reconcile them and to sort of talk about the kind of, the importance of discourse, narrative, imaginaries, right? I mean, there's this whole sort of, what's his name, Carlos Castellanos, the kind of like this idea of, the imaginaries having real material effects, right? It's not just, a bunch of people looking at spreadsheets and numbers in order to make investment decisions, but if you were embedded within one of these big real estate companies or asset managers, or certainly my interviews are revealing just how important these kinds of narratives are, how important the sort of social worlds internal to the firms are in terms of, like you said, sort of who is confident, who people trust to make decisions, sort of what's the pecking order and the sort of hierarchies and the kind of social norms, both within and sort of within the firm, but then sort of external to the firm as well, in terms of watching certain actors to see what their behavior is and then following them. So knowing, for example, that the black stones and the black rocks, have, capital to burn, and that they have sort of large amounts of capital, and in effect they can make markets where they go. So you often see, sort of smaller firms sort of following after them once they've made some investment decision that may have looked on the surface to be kind of counterintuitive or didn't make sense, but it's like these kind of, or if you have institutional investors like pension funds making an investment, they kind of signal the sort of safety of particular kinds of investments. So you will see a sort of herd behavior following after them. So trying to identify who those actors are that can kind of break new ground and find new markets or invest in new building types, and then who the kind of followers and mimicker people, who the lemmings, who they are, sort of following the wake, is a goal of mine. And yeah, confidence is definitely kind of a theme, both the kind of confidence to make, a confidence that you hear in, in my interviews and you sort of read in the materials that are put out. But when is that confidence successful and kind of hurting the crowd in certain directions? And when does that confidence fail? Because it is possible to put out projections like I said, JLL did in the beginning, that were kind of quickly undermined by, the news. And so, like I said, they could not hold on to that V-shaped recovery narrative. So they had to change the narrative, So, but confidence, it's kind of like putting all these propositions out there and sort of seeing which ones stick, which ones don't get undermined by, by reality or by this, sort of bad news. So there's a constant sort of confidence machine that's always trying to kind of reconstruct itself. Sorry, long answer, but good question.
That's okay. Thanks, Rachel. Darek has just indicated that his question has already been partly answered. So we're going to go to other questions first. So there's the next question by Mayra Manjani. Mayra, are you able to turn on your mic?
Yes, thank you, Rachel, for your speak. It was very interesting and nice to meet you also. My question is that I see that the literature on economic geography, they often highlight the need of proximity to produce and share information between financial actors. So I was wondering if you see in your empirical research a strong territorial criteria when asset owners, investors, they choose which financial advisor or forecaster, if I could say, to follow on. And is this territorial proximity still matters for real estate players when following firms that produce forecasts? If so, what are the strategies that you see that are produced by these forecasters to attract new followers, if you could say followers?
No, that's a good question. It's a very economic geography kind of question. How important is proximity and the sort of being there and physical kind of connectivity to, to the kind of circulation of these forecasts and sort of who gets hired, who becomes part of whose network. And I will say, particularly at the level of the kind of global real estate firms, it doesn't seem to matter as much. I mean, they're mostly, you know, they are headquartered in the kind of, you know, global cities of the world, and they have divisions in all of them, and you know, they'll have an East Asian office, and they'll have a London office, even if they're headquartered in New York or in San Francisco. So I mean, I think having those offices and divisions may matter in terms of sort of getting in good with the locals, and having those branches. So there's kind of a level at which, though, the sort of global dissemination of information is happening. And so I think that proximity maybe matters less. Where it does matter more is in the sort of smaller players and the smaller regional players, smaller, you know, developers, you know, sort of small land speculators who, you know, purchase vacant land and just kind of bank it. They just sort of sit on it waiting for somebody to get interested in the land. So in those cases, they ignore this whole kind of world of real estate forecasting, and it's very much about personal relationships. It's very much about the local state being able to predict what like a city government, a municipal government will do. They're kind of like barnacles attached to the local government, trying to anticipate, you know, whether or not, you know, the city of New York is going to identify a particular area for redevelopment or invest in infrastructure in a particular locale. It seems to be the smaller local and regional players that are really interested in those decisions, whereas the global ones are almost like I said, they're kind of blasé about those kinds of, you know, sort of municipal decisions. So it's very segmented. Depends sort of what part of that segment you're in, and that is sort of and your size, you know, what, you know, the people talk in terms of assets under management, AUM, right? So the big firms that have a lot of assets under management, it's like they have the power in some ways to somewhat ignore those kinds of local trends, and are mostly sort of operating with other kinds of global consultants and forecasters. Thank you.
Thank you, Mayra. Thank you, Rachel. We have one more question, and that's good because we're almost running out of time. It's a question from Sabine Dury, but Sabine has almost lost her voice, so she asked if I could read out the question, so I will do that. Speaking of market turbulence and opportunity, is there any reference to sustainability imaginaries in forecasting, either woven into the existing narrative or shaping a new, possibly dominant narrative? If so, what does it look like? Who are the main drivers and who are the winners and losers? Potentially even with a future that partly sees vacancy rise due to increasing work from home.
Yeah, I mean, that's a huge issue. And it's been, I mean, I think it's a whole other book project, and hopefully someone else will. And I mean, I'm looking at this group, and I think some of you are, you know, very interested in this topic. The emphasis on ESG, and that there's a lot of talk about this, and there is the sort of gradual integration of climate modeling, and which is a form of forecasting and trying to predict the extent to which certain regional markets, submarkets will be affected by climate change, and the extent to which that will affect values of holdings, offer up new opportunities. So that is sort of very much on the minds of this particular industry. And again, I was struck by, when I would ask these forecasters to show me their models, I was struck by how simplistic so many of, you know, they are. I mean, maybe it's because I'm in an urban planning department, and so many of my colleagues are into sort of, you know, computer models of our, you know, sort of climate futures, but they were pretty sort of basic. And, you know, there's some concern about sort of sea level rise and coastal properties. But when I would ask about, you know, sort of propensity to flood because of, you know, extreme weather events, there was not that same kind of anticipating, you know, a sort of negative climate future. I really think that kind of information is kind of overwhelmingly depressing in some ways, and negative, that it kind of it rubs uncomfortably against this, like I say, sort of capital, sort of modal sensibility, which is one of kind of, we got this optimism. So yeah, I think it's still the issue of sustainability, I think this is probably an overgeneralization, but is still being dealt with in a pretty superficial manner by this industry.
Thanks a lot, Rachel, for engaging with all these questions, also for an inspiring talk. And we look forward to see your work that's coming out from this. I would also like to thank Fabio Bettio-Contel, who's the co-organizer of this series of online seminars. He will also be chairing the next online seminar, which, contrary to our usual schedule, is already next week. We'll be back at our regular time, so that will be 90 minutes earlier from where you are now. I was going to say what time it was, but we're all in different time zones, so 90 minutes earlier than today. And that will be a talk by one of the winners of the FinGeo PhD Dissertation Award, Manuel. And he will be speaking about doing good with finance, impact investing, and the marketization of youth homelessness in the UK. So I hope to see many of you again next week. Rachel, thanks again. And to everyone, have a nice day or have a nice evening. Bye-bye.
Thanks, everyone. Thanks, Manuel. Take care.
Thanks, Rachel.
Thank you.
Bye-bye, guys.
Bye-bye, everyone.